following program is a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com or search for Options Insider Radio in iTunes.
And now, it's time for the show that breaks down the options market. From unusual activity alerts to market updates and trading strategies. If it involves puts and calls, then our all-star panel will break it down. It's time to hit the option block. With your host, Mark Longo from theoptionsinsider.com and co-hosts Mike Tusaw from KnowYourOptionsInc.com and Mark Sebastian from OptionPit.com. The Option Block is brought to you by Options Express. Don't spend time worrying about your broker. At Options Express, security, stability, and account protection are the most important responsibilities to our customers. Secure account access, enhanced financial protection, entrusted with over $7 billion in customer assets, established financial stability. Options Express lets you trade with confidence. Stocks, options, and futures, all in one account. Trade with a specialist. Visit optionsexpress.com/OXradio to open your free account. Options Express is a member of FINRA, SIPC, and NFA.
All right, and for one final time in 2012, I bring to you the Option Block, your bi-weekly source for all things options related. My name is Mark Longo from the OptionsInsider.com, as well as the ever-expanding, ever-informative, ever-entertaining Options Insider Radio Network. And joining me for this final episode of 2012, we have the Rogues Gallery of contributors, starting off with the lead rogue himself, none other than Alex Jacobson, holding down the Options Express hot seat. Alex, are you feeling quite roguish today?
Roguish is a good term. Happy holidays, everybody.
Whenever I think of you, Alex, the term rogue just leaps to mind. I'm not sure why that is. You have that roguish charm about you.
It's the ascot and the smoking jacket I wear for the show.
I didn't know we had Hugh Hefner on the show with us today. Interesting. Good stuff. I like it. All right. And also joining us, beaming in all the way from the great state of Maine, where he probably is snowed under, because we're even getting some snow in Chicago today. That means you're getting a ton of snow back east. He is none other than the rock lobster himself, Andrew Giovinazzi from OptionPit.com. Andrew, how are you doing this fine final episode of the year?
Knee deep in snow.
Did you get a foot or two?
Knee deep.
Really?
Yeah. No, but happy. My kids are happy. They get to ski. We get to go skiing this weekend. All kind, So no complaints. You live in Maine. Snow is part of the deal in the wintertime.
Yeah, you move up there for a reason. Snow is one of them, certainly.
If you move up here and complain about the snow, you're an idiot, because it's going to happen at 3 months out of the year.
The only problem I have with living up there and skiing is that so many of the resorts, particularly in Vermont and in the area, all shut down at dark. They don't have lights. It's annoying.
We have some. There are some areas that are about 40 minutes from where we live that have night skiing, actually.
I mean, the garbage little bunny hill, essentially, that I used to ski on back in Connecticut used to have lights even. It was so I took that for granted. Then I went elsewhere in New England. I said, wait a minute, everything ends at 4 o'clock. That seems kind of silly.
I mean, yeah, you're right. It definitely, but it's what are you going to do?
These are first world problems, though, to have. I can no longer ski past dark. People are starving in the world, but I can't ski past dark.
But I can't ski past 4 o'clock. All problems, obviously, are relative.
Last but certainly not least, a man who knows quite a bit about moving across snow at high velocity, usually in a snowmobile. He is Uncle Mike Tusaw from Know Your Options Inc., soon to be RCM. I believe the clock is ticking, 3 days and counting. Uncle Mike, welcome back to the show.
Today's the last day that I will ever present myself as a Know Your Options rep. And on top of that, in my mind, it's already 2013.
Already? You're already rolled through. You've already decayed your options to January 1st, eh?
That's right. We're not about to expire worthless.
All right. Thank you for that, Uncle Mike. And now with the rogues gallery assembled, and hopefully the police held off for at least an hour so we can finish all of our roguish daring do here on the show, we're going to do something a little bit different on today's show, listeners. Because it is our final show of 2012, and like we did last year, we're going to take a moment to reflect, to look back on the year that was from an options and from a financial perspective. And there was certainly no shortage of stories leading the way. So I think we're going to start that off with today's trading block is really going to be more of a looking back on the major stories and developments of the options market for 2012. So let's just dive right into that, shall we?
The trading block.
All right, and welcome to our final trading block for the year. I guess before we go, it would be wrong to not at least discuss a little bit of today's action. So we did, of course, have quite a range today. Most of the major indices down over 1%. During the middle, at about the middle of the session, and towards the end of the day, we closed essentially unched on the day. So strong rallies across the board at the end of the day, with Apple dancing around the 500 handle most of the day, closing at 515. Most of the major indices down about 0.1% on the day. VIX cash down 0.2% to 19.44. A lot of whipsaw action as everyone debates back and forth what is going on in Washington. Is there a deal? Is there no deal? Is the end in sight? Is the apocalypse near? Depends on your point of view. I've been loading up on some bearish trades just in case, but that's just me. You may be the diehard optimist amongst us, but interesting stuff going on today. A lot of as pretty much, I guess that could be one of our stories for the year, trends for the year. End of day volatility, particularly end of day rallies. It seems like to close out the day, you could have the most dramatic sell-off during the day. And right around the end of the day, we get these large erratic movements that tend to erase some or not, if not all, of the downside. So these ETFs, these things we've been talking about for the whole year now, this ETPs, this universe of products, really has added a substantial bit of end-of-day volatility, whether it's people hedging vol from some of these short vol trades, whether it's people hedging short gamma, a lot of these different things all combining to just really give us some strong movement at the end of the session. Of course, today we had some rumors, too, that the deal was perhaps nigh for the fiscal cliff, which, of course, added to that exacerbated rebound towards the end of the day. But looking back on the year that was in 2012, I think if there was one grand theme to the entire year in terms of, particularly from an options and derivatives perspective, which, of course, is our purview here on the show, it was really scandal. It was just the complete loss of the customer faith in a lot of this business, and particularly on the futures end of the fence. But a lot of that bled through into the options side as well. Of course, a lot of that has since been seen in the steady decline in retail options volume throughout the year. And I think a lot of that really could be summarized in one key development. Of course, everyone saw MF Global last year and the fallout from that, but I think everyone really got a swift kick to the teeth with the whole implosion of PFG, and with Ross and the guys over there at PFG really just coming out of left field for a lot of people. A lot of people had interacted with them, knew them. I had interacted with them a number of times. No one, I think, assumed that fraud was going on there, let alone to the astounding degree that it was, leaving a lot of clients without their money, with a suicide attempt and all the salacious news and gossip that filled the early part of the year with that. It's usually a bad thing when stories about the options world and derivatives in general are making the front page of the journal. It's never for the right thing. It's never for options, great risk management tools, or anything like that. It's always someone did something, they sold a bunch of straddles and blew out a fund, or they came in and in this case, stole a bunch of customer money and then tried to kill themselves, and all the other salacious aspects that went along with that. So it was certainly, that just seemed to be the year, the overall tone of the year, and it never really recovered from that point from, I think, a retail confidence perspective in terms of options and futures. A lot of the firms who work with, we go to a lot of the industry events, a lot of the exchanges, everyone kind of just operated under this cloud throughout the entire year, and it was, I think, a difficult one for a lot of people to navigate. I know Alex over at OX, you guys had some insight into this as well, dealing with these clients right after that mess and just the calls that were coming into the OX desk day in, day out, asking about how you protect customer funds, transferring accounts over, and just some of the horror stories we heard too, like people who after the Lehman and the Bear Stearns debacles 0809 took proactive steps to move their funds out of FDIC accounts and into futures accounts for that extra level of protection that they thought they had there, only to fall victim to an MF Global or to a PFG. So it really was doubly disheartening on that end, that people could do ostensibly the right thing and then pay such a horrible price for that. So that was, I think, in many ways, particularly from a broad media stroke, the major theme of the options and future space for the year. Would you agree with that, Alex?
Yeah, absolutely. And one thing that's really come through is the importance, as you pointed out, of really having a quality brand and a quality reputation. I mean, you didn't just see it with MF Global and Peregrine. You saw it with Penson clearing and some of the consolidation in the industry. And, there are a couple lessons to take away from that. And one is obviously great brand, great ethics, good people. But there's another story, and this is not the MF Global Peregrine story, but it's a story about the challenges that the real low-cost providers had in a year when volume fell and there were no interest rates. You saw a lot of consolidation amongst the broker-dealer community, and even outside of options, you saw macro funds giving money back. You saw smaller brokerage houses kind of throwing in the towel and saying, look, we just can't make money at these levels. And that's why it's so important in this environment that, don't look for the cheapest, price on the street, but look at the quality of who you're dealing or who you're doing business with. Look at the reporting. I say this every time. No one ever reads the options risk disclosure document. Read the risk disclosure document. Look at the reports on your brokerage house. Look at their balance sheet, and maybe it'll help you sleep a little better at night.
It's ironic. One of the unintended consequences of this, I think actually has been just a shift in the reasoning and the mindset of a lot of those clients, and to see firms like OX and others that have a much more reputable foundation, shall we say, they don't have the same clearing issues as some of the other firms had out there, and also have some of the customer service aspects that we've highlighted on the show a number of times. I mean, a lot of your reps have been on this show, directly interacting with the customers in that sense. So I think a lot of people have seen that and some of the value that is held in that. And they realize that perhaps the race to the bottom from a commissions perspective has some other less than desirable consequences that could come back to bite you. So I think for you guys, even though the general lack of retail trust has been a bad thing as a whole, I think for your firm and a few other firms in particular that are very highly situated with a more reputable brand in the business, it actually has been I'm sure a net influx for you guys, people looking for quality futures broker, people looking for a quality options broker, and tired of dealing with these other firms that have done exactly what we've been talking about here. I think you guys have been somewhat of a bastion in stormy seas.
Yeah, and that's one of the things we pride ourselves on is the brand. And now with the addition of Schwab, we're really a world-class brand. And customer safety and integrity is everything. I mean, in this industry, reputation is everything. I began my career on Wall Street working for a company called Merrill Lynch, and one of our greatest assets, this is back 1980, but one of our greatest assets was the brand. And the amazing thing is, if you look at the financial community in the time I've been in it, even companies like Merrill Lynch, not due to fraud, but Merrill Lynch needed to get absorbed into Bank America, and we saw a very difficult 2008 and 2009, and the attitude of risk on the street is much different. But whoever you do business with, make sure they're a quality partner. Read the reports, and don't rush to the bottom of the fee schedule. As I've mentioned a couple times on the show before, I moderate our OX social site, and I also, because of that, periodically see comments from people on our social site that will take me to other sites, and I kind of lurk there. And one of the sites I was on this week didn't mention the brokerage house, but talked about an extended outage that a brokerage house had on their server, and the fact that there was no backup help desk available, the 800 number wasn't answered, and the customer claimed that they had a catastrophic loss. And I went back and looked at the customer's history on the social site, and one of the things they had looked for was the lowest cost provider. And then complained about how on a stress day there was no one answering the 800 number. The New York Stock Exchange has a rule that says know your customer. Customers should have a rule that says know your broker. And it shouldn't only be price. It should be reputation, backup, what kind of help desk you get, when those help desks are open. At Schwab, help desks are open 24 hours a day, 7 days a week. You can always call. And I'm not saying that as an advertisement. I'm saying that more as a confidence and security issue.
You know, you brought up the Penson issue as well. That's another, I think, broad theme. Gets back to that quality element again. That's more specific in the option space, really. We saw, of course, Penson, the big clearing firm that cleared a lot of the smaller brokerage houses in the option space that couldn't self-clear, go through some of the other more expensive clearing houses, like let's say a Merrill. They of course have been circling the bowl for quite a while, so it was no surprise to see them really coming up against it. But they, of course, essentially were about to go out of business. Peak Six stepped in, and they had already been a substantial investor in Penson. They, of course, acquired all or the bulk of the remaining shares and created this new entity called Apex Clearing. Of course, that posed a problem for a lot of the other brokerage firms in this space who cleared Penson, because now they were essentially being cleared by a company that was owned by the same holding company that owned a competitor, Options House. So that caused a lot of drama and back and forth. Of course, the lawsuit with Trade King and Zecco, who merged, and then, of course, they claimed that acquisition of Penson was done to ostensibly break up their merger. We had George from Options House on our Options Insider radio show about a couple months ago at FIA to address that exact claim. I encourage you, if you're interested in the story, to go back and check out that episode of Options Insider Radio. It was very interesting. But another big story, which is still unfolding really in this space, and this shows the value of a lot of these firms saved money by on clearing costs by going to a firm like Penson. I believe they were saying that at one point Zecco or Trade King was claiming that they had to increase their deposits 1,300% in order to the new standards that Apex was demanding. Of course, that pretty much implied that they only had a hundred or a couple $100,000, or I forgot what it was, a very small amount on hand at their clearing firm for the substantial number of accounts that they had, which of course is terrifying for anyone who actually understands the clearing business and how this stuff works. That you were very close to a potential problem there again. So there were obviously some issues with the way Penson did business, and then of course a lot of these other firms, second-tier firms, shall we say, in the industry, smaller firms, took advantage of that to offer very cheap commissions. But like in a lot of things, you get what you pay for, and sometimes with those firms are now between a rock and the hard place, choosing to be either cleared by a competitor, or which is obviously not viable, or have to go through the self-clearing route or find another clearing firm, which is also not ideal, because then you obviously lose a lot of customers in the transition. So that was another big, I think, story of the year, just all the drama surrounding that.
Yeah, I mean, if you looked at the stories circulating the street, and if you looked at and I have to frame this carefully, what I'm going to simply refer to as the signed NDAs, most of what I'll characterize as the smaller, lower cost houses who didn't have a market making arm or didn't have a balance sheet were pretty much for sale all of this year in one form or another. Now, I know I'm going to get hate emails, but literally there were probably, counting on both hands now, the number of firms that were looking for a deal this year. And listen, in the last couple of years, you saw the two major option-centric firms, Thinkorswim and Options Express, merge with larger firms, because the one thing we clearly had, and we talked about the ICE NYX deal, we'll talk more about it, the great derivative DNA in the firms, and the terrific balance sheets of your merger partners. If you looked at the market-making community in the city of Chicago in the 70s and 80s, and you looked at the great market-making firms, the O'Connors, the CRTs, the Cooper Neffs in Philadelphia, what you saw in the 80s is they all merged with banks because they all had the incredible derivative talent, the great derivative DNA, but none of them had the balance sheets. And you saw the same thing happening in the e-commerce brokerage community. And I suspect in 2013, it's going to be very difficult for the smaller, low-cost players who don't have a balance sheet or a market-making arm to survive.
Yeah, I'd imagine we'll see more consolidation on that end of the spectrum because you're right, it is becoming very difficult to survive on that tier of the business when a lot of your other costs are increasing exponentially. Of course, one of the other main stories we touched on this year from a trading perspective, and since we are on the trading block, that certainly makes sense, is perhaps a name that we discussed more than any other on this show. I'm sure to some fans' delight, some other listeners' outrage. That, of course, is Apple, the big fruit company from Cupertino. They seem to worm their way into probably at least half of our shows this year. No accident, of course. A lot of people like to talk about them. It's a very controversial name. And, of course, we had a lot of price movement in the underlying this year, which, of course, drives a lot of options activity. We saw Apple rally all the way up to right about the 700 level, and then, of course, abruptly come off the other side of that cliff, and today was trading right around 500 even before it finally closed at 515. So I think to call Apple another theme of the year isn't overstating it. If you couldn't talk about Apple enough this year, it seemed. And I know one of our panelists here really had a lot to do with all those conversations. That, of course, is Uncle Mike. So, Uncle Mike, looking back on Apple as one of the main stories of the year, what really catches your eye from that perspective?
Well, Mark, it was the best of times. It was the worst of times.
How long have you been saving that one up?
I just thought of it like right as you were saying it, as I was thinking of the price action of it this year. But yeah, with Apple, it was one where, as a lot of our listeners know, you guys have been making fun of me for being in such a high-priced stock ever since 300. But nonetheless, it's one that it's an American success story in the stock world. It's been a once-in-a-lifetime ride for me, that's for sure, and a lot of our clients, or everyone that was in it anyway. And everything's got to come to an end at some point. And I still like Apple in general, but do I think it's going to reach the 900,000, 1,100 level and sustain the growth that it has? No. I think that we had a really nice ride with it. For the time being, I think it's a great stock to where just looking to sell puts against it or something along those lines is a great strategy. And that just shows how good options can actually be. You mentioned earlier, Mark, how a lot of times when options make the news in that it's someone stealing money or some type of bad press happening. Well, what about the people that want to get back into Apple right now that want to sell some puts against it? That's actually a fairly prudent investment. And you can have a lot of protection to the downside, not protection, but you can have a little bit of a cushion to the downside. Let's say you're selling the 450s or something along those lines. For people that want to get back into Apple right now, I really think that selling puts is something to consider. And it's sad that things like that don't get put into the main media, but that's what we're here to do. We are the flowers of light in the fields of darkness.
We're the 1%.
We are.
We're the option 1%. Take the options and use them properly instead of doing what we euphemistically say, stupid SH, you know what.
Have a hunch, bet a bunch.
I hope no one holds rallies against us now because we're the 1%.
Yeah, but here's the point. Apple, Google, Panera, Priceline, anything you could do with the stock, I can do better in the options market. I can manage risk better. I can hold the stock long-term synthetically. I can create buy points and sell points. Do you really want to take the risk of holding a $500 stock or a $700 stock?
Yeah, and why the margin too? I mean, you got to the thing is the edge. It's again, Alex, you've been working on this. Obviously, Mark started this option pit business, and it's a big part of KYO, educating people on using the options the right way. The problem is people are used to like, oh, options, I'm going to make 10,000%. I mean, if I see one more of those email blasts come through, and I get them too, which of course I would love to make 10,000% on any investment. But if people just learn, and this is a hard thing we try to teach students at Option Pit, just put your trading down for a while and just go through all our webinars. We do daily stuff, but just see kind of the flow about how these things trade and work, and you're going to learn a lot by understanding how the options work, which is what we teach first. Understand how they work first, and then go learn how to make money with them second.
Yeah, and this has been a learning experience for me this year too on Apple. I mean, this is one where I've never hedged or worked with a stock that has had this much movement in one way, shape, or form. I mean, I felt like I was inventing a new type of hedge every day on this thing, and I was doing back spread, combo, covered call, you name it, spreads on it. And it's one that when Mark and Andrew makes a good point, when you actually use it, you can learn more that way. And this year, everything that I put clients in, there was always a reason for it every time in terms of why are we doing this? What are we protecting against? What if this happens? What if that happens? There's always a method to the madness, so to speak. But the fact that I was actually on the front lines with more than just 100 shares of Apple, let's say, doing this, you actually do see things that when there's a lot of pressure on you, and especially when this gets talked about every day, including your bathroom habits on the show, you magically learn things, and it's definitely a good thing. That's for sure.
Plus, you have one of the great doing stuff trades in the springtime when Apple was having those huge moves, not unlike we saw recently, but except you got to buy the volatility was about 22 instead of 42. When you had those ratio put spreads.
Oh yeah, that was one that I've never, in terms of that trade, that was totally new for me because of the fact that there's no way that I was going to do a covered call on that going into earnings the way it was, and especially with volatile levels that it was. So we did a few things, and I just chose not to go to the bathroom for 3 months, and my kidneys are paying the price, but such is life.
You have a dialysis clinic right next to your office, so that's not bad.
He's just plugged in now.
Yeah, I don't even bother with it.
$500 stock with a 40 vol. Let's call it the first of the year, and let's just do two-dimensional math. That means the options.
Buy calls. Stop buying calls. Sell the 450, 55 put spread and call it a day in like February.
Tell you what,
$100 on the calls.
The February 435, 425 put spread is a full standard deviation out. But here's the thing. $500 stock, 40 vol, that means it's got $200 worth of risk over a 12-month period. Why would you hold the spot, the cash, with $200 worth of risk? Because it's got $200 worth of upside? That's still a zero expected return. Anything you can do in the stock, I can do better in the options market.
I think the interesting thing about this, too, is, Apple, particularly over the early part of this year and the latter half of last year, was that quintessential example of the pure upside stock. It did not but rally to the upside almost every day we talked about it. And yet, Uncle Mike, you were collaring aggressively out there. And, we've seen a lot of studies from OIC and others recently that have shown that the collar is effective even in those environments and things you wouldn't think it would be as viable as. And I think you showed this past year too that the collar is still a pretty viable strategy for a lot of our listeners out there, even on a name like Apple, which has, like I said, just rallied to the upside almost nonstop until the recent months when it's been a lot more volatile. And that collar still performed fairly well, I think, for you out there overall.
Yeah, we did okay with it. I think we got into Apple, and this isn't audited. This is just kind of just some quick caveman math that I'm doing here because we got different people in at different prices. But for most of the upside of Apple with the collar, we captured probably about 68% of the upside, in the high 60s for a lot of people. Some not as much, some a little more, but I would say in the high 60s is the percentage of the upside that we were able to capture on Apple. And so we were real excited about that. And it definitely shows that if you continually manage risk, you can do things with this. And most of the time that we were doing that, we had probably over 90%, probably 90 to 95% of the asset protected most of the time.
Yeah, see, on a risk-adjusted basis, you guys blew the doors off of it. And, like Andrew mentioned, we've said a number of times in the show, the call wing is so stupidly bid in Apple. Even all the time, it's ridiculously bid. Sometimes it gets ridiculously bid. And that makes Apple an even more attractive collar candidate because you can get that protection for pennies on the dollar of what it would normally cost in a stock with a normal skew. And then sometimes, who knows, you can even leg into a collar for a credit. I mean, didn't we talk when the stock was trading about 625, looking at, I think it was a front month 600, 6.5 collar essentially for a $2 credit.
It was inverted.
Yeah, it's absurd. So Apple's been a ridiculously attractive collar candidate for a lot of reasons.
It's like doing a collar on oil almost.
Yeah, it is. Apple really has become a commodity stock. It does. It does. So if you're looking for, inverted skew in a commodity sense, you had it in Apple quite a bit. It's come off a little bit now. I mean, but Apple, I don't know if you can ever call Apple's call skew truly like any other stock, because even when it comes off, it's still ridiculously bid compared to most other large equity names out there that are usually.
It did move pretty fast, though. One thing I was pretty impressed of, as soon as like the rally would start to fade, that was the key. You could see that the skew just bake and collapse with within about 25 minutes, literally, after any rally. It's like, everybody okay? They bought their calls. They had their $10, $15 run. Now they're getting out, and it just totally disintegrated again.
So Apple, yes, definitely a big story for us and for the options market in general. I think that brought a lot of new entrants to the option space, for better or for worse. I think the prospect of the mini contracts on Apple will really open up the doors for a lot of people who have been looking at wistfully at the underlying and saying, well, I can't really afford a round lot, let alone to do any options on it. That's going to open up a lot of doors for a lot of people. I think we're going to see a lot more Apple activity as a result of that. On a side note, I think we talked about this before on the show, but on a side note, just real quickly, how ridiculous is it that Apple doesn't split? I mean, this stock did a 10 for 1 and went down to 50, or 20 for 1 down to 25. How quickly would it rally back to 100 or even 200? It would be a couple of months. They're leaving money on the table by not splitting and incentivizing that retail activity. Yet they have this dream of being this super premium stock. I think that's really coming back to hurt them right now. Their Berkshire Hathaway envy, I suppose you can call it.
Well, in Google, where they're playing. And, honestly, I think until Apple comes up with a new product, as far as, look what Apple did this year, it went from 400 to 500. So it was like up, 20%. I mean, it was definitely a great performance. I mean, it was up to 700. It was up a lot more, like 70% or something like that on the year. But it's just a stock, you got to be realistic. Until they get a new product, they're probably going to be a nice, large, growing utility, right? And that's what they've got.
There you go. Use options and make your own dividend. There you go. We'll leave it at that.
Except one difference from the typical utility, they have a literal boatload of cash. And I think the story in this next year will be how they spend that cash. That should be really interesting to watch.
Yeah, that's always been the question with them. What are they really banking all this money for? I think a lot of it early on was due to just Steve Jobs being a very paranoid figure. He saw what happened to Apple the first time around. He got forced out. The company got in some dire straits, and they were at the mercy of other firms. He had to go begging hat in hand to Bill Gates from Microsoft. Couldn't have been a banner moment for him. So I think he probably swore that he would never do that again, so he stockpiled cash just for that reason. Now I think the new management probably has a little bit more enlightened view on that, and they're looking to spend some of that. They're even talking about manufacturing some products in the U.S., which is interesting and certainly is going to eat up some of that cash. So there's, of course, manufacturing the number and scale of items that they do and ensuring production capacity around the world and all the other things, that also requires quite a bit of cash as well. So they're putting some of that to good work. But $100 billion or whatever they have in their pockets now certainly
it's all
is
overseas, right?
Yeah, it's all overseas. Yeah, it's all overseas. Another big trade story this year, I think, that caught a lot of our eyes and really just illuminated some of the dangers we've been talking about on the show quite a bit, was that big dividend trade disaster with SPY back a few months ago. Of course, you'll remember SPY wasn't a surprise dividend. It's a regular dividend that SPY does. Some players came in, of course, to do what they always do, trading that dividend trade, again, it looking to speculate and capture that dividend on people who don't realize that the dividend's coming out or just don't have the wherewithal to exercise their options to capture it. Of course, there was a clearing error on Merrill's end, which ended up costing them somewhere between $10 and $20 million. And I was hoping this story was going to be a bit of a ray of light to finally show to the industry that, hey, people have been saying for a long time these div trades are negative, we should get rid of them, but no one's really been taking any proactive steps to do that. I was hoping this $10 to $20 million hit over at Merrill would really open people's eyes to the fact that there is danger and risk in these things and just start banning them across the board. We saw some proactive steps from the folks over at Amex NYSE. I was really happy about that they stepped up and said, hey, we're not going to take these trades anymore, and we're not going to accept them. And so by eliminating their fee caps, they essentially said we don't want their money, which I thought was a noble thing to do, putting their money where their mouth is. Unfortunately, no one else has really followed suit. At least some of the major players like Philly certainly haven't. So we're still kind of back to square one from a dividend trade perspective. But still, that was an interesting story just to see the true dangers and risks that are inherent in these trades. And people are putting them up in stupid ways now. They're doing, they're putting up, we used to do these things for 100 delta calls and 99 delta calls. Now they're doing them in like 60.
Pushing the envelope.
Yeah, they're doing 60 delta calls. Any strike that has any open interest, they're doing thousands of contracts to try to capture a couple hundred contracts of open interest. It's really stupid. And this came back to bite them.
It's market manipulation too, because you're basically saying you can trade commission free, realistically. And if the SEC actually understood what they're trying to do with these, they would probably say, hey, listen, I would say it's not a level playing field for everybody. So if you're going to trade, you're going to be able to put these things on in size and not pay anything. I think that's just the market's being manipulated, and they should, put an end to it. Stupid.
Yeah, it's bad on a number of reasons. Alex, I'm sure you have a lot to say on this as well.
Well, I will tell you one anecdotal story is when I called on macro funds. One of the macro funds that gave a lot of money back this year that said, we're giving our customer money back was burned in a rather large div capture trade, which they had calculated down to about a 10-cent transaction cost. And of course, it was done for free. And they threw their hands up and said, we're done. And it's a macro fund that when I called on them, traded a couple million options a year. And I think that's part of the problem we had with the macro funds this year. And to Andrew's point, if you can trade for nothing, it's not a level playing field. And something's wrong. And whether the regulators understand it or have other things on their plate or other things that are more important,
they don't get it. I'm absolutely convinced they don't have a clue.
Yeah,
if there was somebody like Alex there running the SEC options part, then they'd have somebody that actually knows what's going on. But I just don't see it. They let all this stuff go on, and I just really don't think they actually understand. They don't have enough traders working at the SEC.
There's still a lot of politics in regulation. I know that comes as a shock to everybody. And
Mark, do you believe that?
Stunning news. Breaking news here on the Option Block today.
We have Alex just broken the hugest thing. There is politics and regulation.
Dodd-Frank did a handful of things that, in my humble First Amendment opinion, were really foolish and didn't do enough of the things that it really needed to do to make the industry a better place.
Yeah, I'm still trying to figure out, two of the guys most responsible for the financial crisis wrote the rules to fix it. I'm still trying to figure out how that all works. And they're both off right after they did the rule.
Yeah. Welcome to Washington.
Yeah, the whole Dodd-Frank thing, particularly from our perspective, a derivatives perspective, has just been ridiculous. I mean, part of the problem is they bandy about this term derivatives, which I always tend to try to avoid the D word because it's just so pejorative now. When really the bulk of the danger and the disaster came from the OTC side, the very highly unregulated side. You didn't see an implosion of risk or destruction in listed cleared options. That wasn't the case.
None.
Yet they're all lumped together. Exactly.
structured products that these guys wanted.
Exactly. You had firms like, AIG essentially selling downside puts or the equivalent to the entire world with no potential way to ever hedge them or even thought to how to do so. They just wanted to collect that premium all day.
The best Dodd-Frank, the outcome would have been just a totally transparent OTC mechanism, just like how the OCC operates. Here's your counterparty, here's the money, except the OCC monitors how much money you have on balance. And that's it. And the problem is those guys don't want to give up that freedom, but that's what it should be.
Yeah, there's a lot of...
when was the last OCC regulated firm really that blew up and blew all their customers up? You got to think back for a while, right? The CFTC, that was Peregrine MF Global, that was CFTC. But as far as OCC, good old vanilla options, and these options move from anywhere from a penny to $20 in a day, right? Any giant firms blowing out anymore? I mean, the option business learned their mistakes in the crash of '87.
Right.
So that's why you have the third party in there. The OCC is, now they understand how to margin all this stuff. So there's several layers of risk management in the OCC. You've got like the option express risk management, right? You've got the internal controls. Then you have the OCC requires the capital. So you have these layers, then you have the exchange. So you have these different layers constantly making sure there's X dollars in the account all the time. And it's very hard to try to get around that fraud. And that's the thing that people really aren't getting is that transparent mechanism really works because you can't hide anywhere, right?
Yep.
You have to have the money on basically on account. You have to have a balance or they shut you down in one day.
Yeah.
It's not even a question.
The SEC. I'm sorry, Andrew.
No, what I'm saying is there's not even a question. Like you don't have the cash, they blow you out.
The other thing about the SEC and the CFTC is they view their role as archivists, not detectives, and that needs to change. What went on the future side this year was just an abomination. And it shows you that we really need people in regulation who understand the product and who aren't complacent and who aren't in, wonderful buddy relationships with their member firms. And that's got to change. It's just got to change. And that's what Dodd-Frank
Costello.
Well, that's what Dodd-Frank didn't do.
I don't know if we're ever going to crack that nut of having people at the SEC who really get this product. They're so overtaxed as it is just dealing with their main purview of stocks. And of course, Bernie Madoff really made them look like idiots. They doubled down to try to handle that level of enforcement. Options, it always was a secondary thing to them. Now it's even more so a secondary type of affair. There were a handful of people on different committees there that had some understanding of options. They've since been poached by a number of industry firms. That's part of the problem as well. If anyone becomes the known go-to person at the SEC for options, they get picked up. They get poached. Yeah, so they get poached by Goldman or Gecko or some other firms out there. And so we're left with the same old, mid-level bureaucrats for the most part who really have no options understanding to begin with. And they're expected to be able to deal with all the vagaries and complexities of this space. And it's hard for someone who's in this space to do it, let alone one of them. And of course, we all know the bureaucracy teaches you not to take risk, but to keep your head down below the sand where it can't be cut off. So you don't really take risk, and that's what you need to do when you're looking to approve new products or regulate on things like dividend trades or payment for order flow or any of the other things that have come up in the option space over the past decade. They've really kind of washed their hands of the space and said, hey, let the chips fall where they may. Luckily, the industry has done a decent job of mostly policing itself, but it's still kind of the things like this, like the div trades and others, still manage to make their way to the surface, and it's unfortunate. I don't know if that's ever really going to change. OCC, it's not really regulatory. It's more of just a clearing entity. So to have I don't know if we're ever going to get that level of industry knowledge, short of a guy like Alex going off to Washington. I think that's not a bad idea, Alex. Why don't you call up the
Alex
SEC?
Off to Washington.
Mr. Jacobson goes to Washington.
The option business is they have cleaned up. The rules are pretty solid. So mostly where people get blown up is when they just do stupid things themselves. Ultimately, when you look at the div trades and stuff like that, it's just like the guys in the financial crisis. You're all big boys. You want to put on a 400,000 contract div trade, and you assign some mid-level kid who's only been on a desk for 2 weeks, to make sure all the paperwork's squared away, at that point, I would say it's a pretty significant risk. And if it blows up in your face, it's your own fault.
But to your point, Andrew, if I couldn't do it for free, I simply wouldn't be doing it. And if we're going to protect,
it's a no-brainer.
Yeah, if we're going to protect customers, we got to level the playing field. Yep. You can't say just because you're big and you hit the fee cap, you trade for free. That's
just anything where I think you give an unreasonable advantage to somebody else. I don't see that. Now, the only good thing is for most retail customers, they don't see the downside of, we're just talking about the retail trading population, not but I would say the big retail, like a hedge fund is still retail. I mean, they're big retail.
Yeah, but they do, and even ma and pa investor, when they lose their Procter and Gamble because of a div trade, and then they get the explanation, they go, well, I couldn't have done that. Why could it happen to me? And then they turn around and say, I quit. I'm not writing covered calls again.
Right. Yeah, you got a point there.
Let's close up here with a couple of other quick topics. There's so many we can cover. We've already gone almost an hour, which is hard to believe. A couple other big stories, of course. I think another central theme of the year, at least from a broad media perspective, looking at options, has been just beating that drum of, the VIX is cheap, the VIX is low, volatility is low, all the other nonsense that surrounds that. Of course, we've disproved that to death on this show. Of course, talking about the real cost of protection, looking at the VIX futures term structure, looking at how these things actually trade. I mean, there's a lot of reasons why that's a nonsense type comment, but still, we've heard that so often that it really is one of the themes of options this year in terms of, VIX is cheap. I can't tell you how many people I've talked to when I bump into someone in, the quote unquote mainstream media, or even the general financial media. Why is VIX so cheap? Why is vol so low? And having to walk, I just did this a week ago at a media event that was in town, talking to a mainstream columnist who was supposedly a financial writer, asking me these same questions and walking her through the reasons why that's not the case, and seeing her eyes just glaze over. It's just one of those things. They should
all take our gold class.
Yeah, there we go. Here's their card.
Like 3 months.
Spend a few $100 going to these classes if you're going to actually write about this stuff. Another big story here, of course, the debacle with night trading earlier this year, highlighting some of the risks inherent in these technology surges we've been seeing on the options and on the underlying side. Night, of course, imploding as a result of it. Most of its order flow providers really kind of twisting that knife by saying, hey, we're turning off our spigot to you. Night stock gets crushed as a result. They swoop in a couple days later and scoop up the remains. Getco finally gets the rest recently, announcing their final buyout of Night. So not exactly a banner year for Night. Of course, Hurricane Sandy really being a big black eye to the industry, and a lot of people saying, hey, it's not the options fault, it's the underlying. That certainly is the case. We had Steve Crutchfield on from NYSE, Amex Options, and ARCA Options during the FIA show. He's the lone representative of NYSE who made it into town in Chicago during that event, and I encourage you to listen to that as well on our Options Insider radio show to hear what he had to say about how the options guys were ready to go in hotels around the city, and they got the call from the main exchange saying, hey, no go. But that really just shows that all this disaster planning and recovery that we've been doing since 9/11 really is a joke. If the boils down to the fact that if New York City or downtown Manhattan is impassable for any reason, the markets are going to shut down, and we need to work out some way that is not the case, because that's ridiculous in this day and age.
Hard to
have
believe,
that.
Really.
It really is, and to have people throughout the country and throughout the planet, really across the planet, just have to sit on their thumbs for 2 days post Apple earnings with the vol going through the roof and all these other things happening, not being able to get out of their positions because downtown Manhattan is inaccessible. That's really unforgivable. And we had a chance, talking earlier, the main theme of loss of customer confidence in the industry as a whole. That was a great chance to restore it. Say, hey, you know what, we got our stuff together and we planned for the last decade, and we're not going to shut down because this big storm, which is a totally foreseeable event, came to town, and yet it happened, and they did shut it down, and for several days, and it was really, I think, an embarrassment for a lot of people, and also very dangerous and damaging for people. And talked to a lot of guys who had stuff they were waiting to take off, short vol positions post Apple earnings. You'll recall on that Friday, vol didn't really come off like a lot of people thought it would, so they held it till Monday. Perhaps not the best choice, and certainly once that hurricane came through, not the best choice, but then it'll shut down until Wednesday. That, of course, came back to bite them quite a bit. So a lot of negative connotations from that, left a bad taste in a lot of people's mouths. I think we need to work as an industry to overcome that. Of course, recently mentioned over at the CBOE, Brodsky stepping down, Ed Tilley taking his place. I think a lot of people here on the show are enthused about that because most of us come from a market making background. It's nice to have someone who's actually made a widget, running a widget company. Nice to have someone who's actually traded.
Even though the widget is an option.
Yeah, the widget has changed. I think you can certainly take that approach, that the widget at the CBOE is a little bit different than what it used to be. But still, it's nice to have someone who's actually made the sausage, running the sausage factory on the cast. I think that's part of the problem with a lot of these exchanges is having these non-member people who have never been a member and actually performed the core business of that entity running the show. And you get a lot of these crazy decisions that have come out of it as a result. So perhaps that'll be an interesting development. Of course, CBOE, I think a lot of us are thinking they got a nice bump from the ICE deal, which we'll talk about in a second. But of course, CBOE, who knows the long-term prospects for them with CME holding a lot of their cards. Perhaps Brodsky was seeing the writing on the wall, wanted to get the heck out of Dodge before CBOE has to go hat in hand over to the CME to get their future sorted out. And of course, on the exchange front, the big news that came out this past week, ICE, who has involved themselves in a lot of deals over the years, some I think with more clear intent than others. I know Jeff Sprecher over there likes to do a lot of these deals just to get a lot of ink for his exchange. He's admitted as much many times, so it's not exactly a secret. This time it seems to be a legitimate operation. They're putting the money together. They're outlaying a lot of cash to pick up a very storied name in the business. Remains to be seen how this will impact options. NYSE obviously has two exchanges. From an equity and index options perspective, ICE has really nothing from an options perspective except for some OTC energy contracts. They recently added some ags and some coffee contracts, but not really a big player in the options sense. So it'll remain to be seen how all this stuff shakes out. I know Sprecher has made some interesting comments about payment for order flow and the way these orders are routed to the exchanges. Think that's a good practice for the business. May want to clamp down on that, both on the underlying and on the options side. So that'll be interesting to see how that plays out, particularly in a very competitive space like options, where exchanges usually have to pay to play.
You would think he's going to have that figured out, though, before he buys the exchange.
Yeah, you think before he throws around all that cash to pick up the exchange, he would have something like that sorted out. But
I suspect he's got a plan, and I suspect the big story next year will be the way rebate trading and pricing changes. And I think his vision, and as you said, Mark, you know him a little bit, and I've had the opportunity to work with them on a couple projects over the years. I think he's got a vision there of changing the economics of the industry, and it may be tough sledding, but I would sit up and pay attention to what's going to happen here. And I think this show a year from now, we're going to see a different pricing environment. And I think we're going to take away some of the trading in the marketplace that is not helping us any.
I think that would be interesting. I think a lot of people would be behind that. I certainly hope Sprecher could pull that off if that is indeed his plan. And it makes sense, him coming from somewhat outside this business and from the OTC energy realm and looking at how it's done on the listed options and equity side and saying, wow, this is crazy. I think that dovetails with what a lot of customers say when they first realize how their orders are actually routed and how all that stuff is determined. They say, wow, that's kind of dubious. People getting paid for this and routing orders that way. I think if we can figure out a better, more transparent way to do it, I think a lot of people would be behind that. And so maybe Sprecher's the one to do it. We'll see.
He's a disruptor, and yeah. I suspect this industry will look very different 12, 15, 18 months from now.
Yeah, well, I mean, ultimately people have to figure out, a lot of the order flow now is a lot of liquidity providers. What was this? 5 probably main liquidity providers at this point. There might be a couple more, and there's a lot of scattered little guys. But most of the large liquidity providers have, retail housing on a house on the other end, and that helps keep the cost of execution low as well. I mean, there's a lot of these routing priorities everybody's got to figure out. They still get the MBBO, but I will be surprised if he can come up with some sort of magic serum to make all this work out.
I like it. The options magic serum.
More power to him.
Yes, I agree. If that's his plan and he can pull it off, then I will take my hat off to him very, very clearly.
It makes it worthwhile to be a market maker again.
Yeah, well, I don't know if anyone has that magic sauce. I think that genie has, to mix all of our metaphors, that genie has very much left the bottle. And I don't know if anyone has the power to put that genie back in. But I think since we only got to one block today, but this was pretty much our main block anyway, our trading / story of the year block. Since we are on the trading block, we'll finish it up with a couple of interesting things. Quickly, I think some notions for products that really caught our eye this year. Of course, weeklies continue to be the dominant story. The expansion of weeklies at the beginning of the year really was just the front week and that second week towards the end of the week, and that was really it. And that manner of listing really helped to drive a lot of this, rush to sell and hit the bid in the weeklies that a lot of us have really kind of slammed on this show as being not exactly the wisest course of action. They've since have listed the full month, now added that fifth week for a lot of contracts, so that really has expanded the opportunities for weeklies. I know Uncle Mike has extolled the virtues of the 5 weeks worth of weeklies many times here on this show, and it allows you to have a lot more nuanced options, pun intended, when you're looking to set up your strategies, particularly on the premium writing side and financing some of your hedging that way. Of course, a very more recent addition to this, the variance contracts over at SIBO seem to be having a new life. They've rebranded them, they've restructured them, and suddenly seem to be actually catching fire, which is interesting.
They priced them right.
Yeah, they actually priced them right. So they talk about tipping our cap, tip my cap to them as well. They did what they needed to do, took their contracts, kind of shut them down for a while, really went back, did their homework, say, why didn't this product succeed the first time, have relaunched them now, and they seem to actually be in line with the OTC, which is what they wanted all along, and now they're actually getting some attention. Of course, an honorable mention has to go out to those mini contracts, mini Apple, whatever you want to call them. They don't really exist yet, but they were one of the stories of the year. They took off really at OIC this year with everyone talking about mini. ISE and NYSE kind of went head-to-head for a while. To the industry's credit, they sat down and actually got a viable product out the door before the end of the year, got SEC approval, and now it's going to be launched mid-March, it looks like now. So hopefully by next year, that'll be our product of the year next year, the mini Apple. And maybe we'll wrap it up. We do a lot of unusual activity on this show. Going through all of it to find the stupidest or the most interesting trade of the year was a hard one, but I think off the top of my head, I really had to think back to what stood out to me. And Andrew, you like this one. I think it has to go back for many ways. There were trades that performed worse than this because this one pretty much lost 100% of its value, so that's not very good. But the net cost wasn't that much. But still, I think this trade just personifies so much of what we rail against here on this show. The stupidity, the lack of understanding of how the product actually works, the wrong frame of reference, all these different things. It has to be going back to earlier this year when someone got the bright idea to buy 20,000 VIX Feb 70 calls. And if you look right now, those ridiculous contracts are still open, all 20,000 of them. And for so many reasons, it really just, it warms the old cockles to see that, or I should say saddens me it warms the cockles to see someone like that perform so badly. Hopefully they will learn their lesson because they don't listen to a show like this, obviously. If they did listen to the show, they would know that that is a terrible trade. But that also just reinforces so many of our themes. The size money is not always and frequently is not the smart money. B, understand VIX. Feb 70, that's absurd. I think anyone with any knowledge of this product understands when we have a sub 10% realized vol that to go out and buy a 70 in the VIX is absurd. You see why people are actually selling 18s and 16s to buy Feb 70. Stupid trade in a lot of different ways. Also, how many times on the show have we gone on about not buying upside calls? There are so many better ways to do it. Do verticals, do ratios, do what Andrew always says, don't pay for your premium, get your free juice. There are so many better ways to do it than that. So that trade personifies so many of the things we have railed against on this show that it kept coming back to me as I was looking at all the other trades we outlined and this 1x3 and how this performed. This one trade really just personifies so many things that has to go up for me as kind of one of the worst, if not our worst trade of the year for so many reasons. Andrew, I'm sure you really love that one.
Yes, I was just having a sneezing fit. I had to mute myself. And really, that's
how crazy the trade was.
Yes.
And this is one thing I've noticed too. Now that I spent my year teaching, let's say retail, I think by and large, a lot of people are really good on direction and they do research on stocks and all this kind of stuff. And really what they're lacking is exactly what we rail about on the show, is they just buy the wrong thing. Now that guy could be, he was right that the VIX is, I don't know when, I can't remember when he bought them, but the VIX went up. But the thing is it's what contract do you buy to take advantage of the going up? How do you work into it? How do you, you've got to understand, once you understand how the products work, all the time you put into looking at other information, research, just trading the news, whatever, gives you such a bigger, better chance of success. You think about it this way, it's really tough to go in, you've got your toolbox, and to start fixing the engine of your car when you really have no idea how to do it. You need to get somewhere, okay? The destination, but you have a bunch of tools you don't know what to do with, and you have an engine that's not working, and you try to do it anyway. So it's not a very good idea, and it's not just listening. A good thing about this show is there are just ways to approach how to do things you want, and with options, there's always a best way. And Alex was saying that I can always find a better way. And with options, you definitely can find the best way to accomplish what your goal is. There are also really ridiculous, horrible ways, and you will lose all your money if you try to use those ways.
Yes, it was September 5th. I just looked while we were talking. September 5th, they went up 20,000 times for 25 cents. So from a net outlay perspective, it certainly wasn't the most costly trade we outlined on the show today. But for all the reasons we just described, it really stands out in my mind as one of the worst, if not the worst, trades that we profiled on the odd block this year.
Well, another thing, too, is you probably do like 1 by 3 on that position. So obviously, clearly, the guy's got some margin. And created it so you probably would have made money if the VIX went from 28 to 160. You still could have been profitable. You know what I mean? There are ways to create trades that
exactly
help.
VIX 2540 1 by 3. You better than anything off the top of my head. There's a million ways you could have gone with that. That still wouldn't have been as great, but it would have been a hell of a lot better. Than,
it wouldn't cost you anything, bro.
Yeah, he wouldn't cost you anything, and hey, you get some bang for your buck, and certainly a heck of a lot better than Feb 70s.
Because you probably you could unwind it again. Who knows what the guy was really doing? Maybe he has a. I don't even know what he's going to hedge with that. That's the problem.
That's the thing. There's nothing that offsets that makes any rational sense.
Unless he sold. The only thing I can think of is it was an OTC trader, and he sold something to another customer for more. That's usually when I see stuff like that. It's the only thing in the back of my head. He bought those, but he sold some contracts.
Yeah. Either way, there still is some poor schlub who picked up 20,000 of those things, probably for more than 25 cents, which is awful.
Exactly, for 50 or 65.
Looking here, there's 24,000 of the Feb 65s. Maybe he had a chance to spread them off. I doubt it. I think he bought both. Either way, not a great trade. I think that's.
I'm liking the doing the odd block stuff too, because I'm seeing. I've never been really a paper watcher, but now I've just generated.
It's fun.
Huge watch of activity for me on some of this stuff. I'm like, I see a tick here, a tick there. And it's kind of fun stuff to trade.
It is fun, and it generates ideas, and it also says, hey, this guy's an idiot. It's something fun to talk about on the show.
That too.
Those are always fun too. Slamming the simpletons. Maybe we'll call it the simpleton block going forward. Well, unfortunately, that is going to do it for our end of the year wrap up. I think I'll go around to each of you before we go. You can leave our listeners with one thought for what you're thinking of for the coming year, or maybe something you're thinking of for the past year, one thing that you want to leave our listeners with. Looking forward, looking back, I'll leave it up to you. Maybe we'll start with you, Uncle Mike. What's on your mind for our listeners as we do close out our final show of 2012?
Two things. The first one is you never know. You can always learn things when doing something in this business through the trading world. If you're consistently watching the markets and doing everything that you're trying to do and managing risk, you're always finding and learning new things. No matter how long you've been in the business, there's always something new to learn. And the second thing, for the last time in my entire career, I want to tell everyone it's important to know your options. Now, with that, we'll be changing the name. Everything's going to stay the same. We're expanding in a couple of things next year, but Know Your Options is going to be RCM Asset Management come January 1st. So that is all I have.
That's a bit of a sea change over there, a sad one. We had Uncle Mike on our advisor option show earlier today, and he seemed a little bit happy that the transition, it's a positive thing, obviously, so he's excited about that. But of course, you're always sad to see a brand that you work so hard to build and grow be subsumed by something else, so there's always a bittersweet moment from that respect, and that's been Mike's baby for as long as I've known him. So it's certainly a bittersweet moment for him, and certainly for you guys who've all been KYO for so long. But of course, only good things ahead for RCM in 2013 as we look forward to what you guys have going. And of course, I'm assuming the webinar train will roll on.
We are rolling it on. I'm trying to get Seabass to email me back. I wanted to get him to get the lead spot again, but please make sure that he emails me back, Andrew, whenever you get it. All right.
All right. Thank you for that, Uncle Mike. And you have a good end of the year and a happy new year to you and yours, sir.
Thank you. And Andrew, what is on your mind here as we close out our final program for 2012?
Just real quick, it's this year, and then this I'm going to do for our thing, the volatility report or the VIX report we put out. But I just found a preponderance of market binomial events this year. Like there's just this huge structural, the euro is going to be destroyed. It's not going to be destroyed. We got the fiscal cliff. Greece is in. There's just all of these huge events that really turned equity trading for the indexes, mind you, the big indexes, into these really crazy, 3, 4, 5% potential movement, and they're telegraphed so far ahead in the future. So I don't remember seeing, those things used to kind of sneak up on you, back in the day. And now it seems like, I don't know if it's because we have all this monetary easing, there's all this money floating around, governments can't quite stop spending money. But I'm wondering if this really is kind of part of like new normal. There's going to be these yearly big events that really. And I don't think it's good for the equity business because it scares customers away, but it scares retail investors because they don't know what's going on anymore. So, I mean, it's better for our business about education, but I'm seeing a lot more of this than I remember it being. Maybe it's because it's just the euro crisis has been kind of on and off, and maybe that's once in a generation problem. I don't know. I don't really see it really solved yet. But I think some of these things are going to keep coming back, and obviously it gives us lots of fodder for the show. But I don't see them exactly going away quite yet.
It's an unfortunate. I think it's an unfortunate development. I think just we've seen, you're right, all these events this year, last year with the debt crisis. I think was sort of our introduction to those massive binomial events. Europe followed shortly thereafter our downgrade. We're in it right now with the fiscal cliff. Will they? Won't they? Certainly complicates the trading waters. I mean, if you're coming to us learning how to trade options and want to start adding options to your portfolio, even if you're a seasoned options trader, it certainly with these type of binomial events, it turns all of your options positions into almost binomial options positions.
It really does, and you really have to position for it. Now. If you hedge a little bit, it gives you a good opportunity because that means you get to unwind your hedges for what I would say is probably some pretty good dollars. But you can't forget that you got to do that. You have to do the stuff still. But I'm wondering because we do have this sort of this overarching. They're trying to fix everything with monetary policy, and they're not really trying to do anything from the fiscal side, at least from what we can tell yet. Right? They really haven't gone to the mattresses yet. That this is just a symptom we're going to have for, and then we are going to have that cheap 13 VIX, but, the futures 3 months out will be trading for 20. We'll still have those same types of problems that we had in 2012. So I don't know if it's really going away. I can't say that it is. I don't think it's great that it's here. But as far as us, we will be running our daily webinars. We're adding a couple products, help desk, things like that for people that want a little bit more, and we'll just kind of keep moving on. I mean, our classes are selling out every month, and things are going well at Option Pit. So generally, volatility is good for us, and once you understand how to trade volatility, it'll be good for you too.
There you go. I like it, Andrew. Summarized quite well, sir. Last but certainly not least, Mr. Alex, what is on your mind here as we close out 2012?
Just want to reiterate something that Mike said earlier. Talked about his collar trade at Apple, where he had 10% of the downside and 68% of the upside. It's not how to get rich, it's how not to get poor. The most successful option trader I ever knew, I mean, a fellow who literally took $500 million out of the marketplace, was a former card counter. And if you think of the mentality of the card counter, I know some people don't like the gambling analogy, but what card counters are really good at is not losing money. And if I can craft a trade that has 10% of the downside and 2/3 of the upside, that's what the option market is about. So it's not how to get rich, it's how not to get poor. Famous stories, people like Jesse Livermore, I just want to take out the middle 2/3. I think that continues to be the story in the options market. You have equity markets and bond markets that haven't done anything for the better part of a decade. If you looked at just carving the middle of that market out, you've had a tremendous decade and you've doubled your money. And that story has to resonate with every investor. One other quick point, and this isn't a recommendation, but one other quick point from a tax standpoint. Everybody remember Monday is the 31st. If you're involved in any contract that has a mark-to-market tax feature, Monday is the day. So please don't forget.
Words to live by, sir, as always. Thank you, Alex. Thank you, Andrew. Thank you, Uncle Mike. On behalf of the listeners, I, of course, want to thank all of you for joining us on the program this year. Of course, tip of the hat to old Mr. Sebastian, too, has also been a regular on the show this year and for making such a great show for our listeners throughout the year. On behalf of myself and everyone here at the Options Insider and the Options Insider Radio Network, as we close out 2012 and look ahead to 2013, we just really want to thank everyone who's helped make our network and our site and everything else such a success this year, including our partners on the radio side, and of course, all of you, the listeners. Without you, all of this would be for naught. You guys writing in, giving us your feedback, downloading the shows, streaming the shows, going out of your way sometimes to find different episodes. It's really just been, I think, a fantastic whirlwind for us to see the uptake on your end, and how when we first started this business way back in January of 2007, coming up on 6 years ago now, and everyone thought, oh, there's no interest in, long-form derivatives content online. There were no other options podcasts to look at. We really kind of got that ball rolling with Options Insider Radio, and have since just seen that idea, that little germ of an idea, expand into this full network. And with all the plans we have in store for you guys in 2013 with expanding the network, adding new shows, adding new ways for you guys to access our shows and find them, making them even easier for you guys, perhaps putting them out on more outlets, including terrestrial and other radio outlets, perhaps adding video so you guys can see our lovely faces, and a number of other things, events, everything else you guys have been asking for a long time. It's all in the works here at Options Insider and at the Options Insider Radio Network for 2013. So on behalf of everyone on this show and all of our other shows on the Options Insider Radio Network, I want to thank all of you for joining us this year and making it such a great year, and have a happy holiday to you and yours, and we'll see you all next year for another exciting year of Options Insider Radio Network programming.
Become a part of the Option Block. Just visit www.theoptionsinsider.com/forum to post a question for the hosts. You can also submit questions to twitter.com/optionblock or leave a voicemail at 312-544-9356. Make it interesting and your question just might make it on the air. The Options Block is property of the Options Insider Incorporated. All rights reserved. The preceding program was a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com/radio or search for Options Insider Radio in iTunes.